So, hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm going to analyze Palantir. This is one of the stocks that is one of the most frequently asked stocks for me to analyze. So today we're finally analyzing Palantir. So, a few disclaimers. This is not financial advice. Do your own research, and the data that I've taken comes from Seeking Alpha and the New York University website for the risk premium, especially. So, before we get into the video of today, I want to say today I'm not going into the fundamentals of Palantir. Um, if you want, you can find an old video that I will link in the description below that goes very deeply into the fundamentals of Palantir in order to really understand what they do. I've done that video with the guys from Convequity, and I really recommend you to follow them on Twitter, on their website, and so on. They really have a good understanding of technology, the underlying technologies of these great companies, and the financial knowledge, because Jordan has the CFA, so he is really good at analyzing financials and so on. And I'm not getting paid for mentioning them. I really think that if you want to get a good understanding of the underlying technology, you should follow them. So link below. In order to so let's start with the financial analysis. First, we understand the basic assumptions that I've made in order to come up with a valuation. So first of all, we come up with the weighted average cost of capital that is made of the cost of equity and the cost of debt. So the cost of equity, I've taken the interest rate swap that right now at the time of this recording is around 4%, and the risk premium, I've taken it from Aswath Damodaran's spreadsheet, and for this year it was 4.6% for the US. Yeah, and I've taken the last 24 months beta that was 2.17, that is pretty high, and it can influence the overall valuation, make it look less valuable than what it actually is, and we'll see how to change it along the way. Next, we go into the cost of debt. We take the same interest rate swap as a reference, 4% plus a spread, because of the risk in investing in companies' debt rather than the US government debt. And yeah, I estimate it to be around 5%, because the debt to capital ratio is extremely low for Palantir, so it makes it very very safe. I think that maybe as the company progresses, it should rely more on debt in order to lower its cost of capital and reward more the equity investors, and by increasing the return on equity and relying less on equity. So here's the assumptions. Here's the weighted average cost of capital that comes as a result of these figures, and here's how I expect it to be going forward in the medium term and long term. So we don't have that much data going backwards for Palantir because it's a relatively new company and it hasn't been listed for so long. But yeah, we can get some understand some of the trends. We can see how it has performed over the years. It has grown a lot, really a lot, and I think it can continue to do so. Maybe not at the same speed, but it is very well positioned. It has a strong moat. It has a pivotal importance for the U.S. national security and the, let's say, Western world security. So I think it is very well positioned. So here's the assumptions. Here's the past data, and here we start making assumptions for the future. So So here's the growth that I expect to see going forward in the next 2.5 years, more or less. Yeah, around 40%. We can see that it has done really, really well in the past, and maybe not at the same pace, but I think it can continue to do very well. So, yeah, I expect it to uh, increase the free cash flow also mainly because of the revenue growth. We can see that it has grown uh, pretty well on a year-over-year basis, and also increase its margins and decrease the cost of capital. So these are basically my assumptions. So I expect it to do about half of what it has done in the past 5 years, so around 40% growth for the next 2.5 years, and then I expect it to be around 25% until the 10-year mark, and then I've put the long-term growth. Usually, in corporate finance lessons, they would tell you not to go over the expected sustainable GDP growth rate. But in the case of Palantir, amazing technology, uh, incredible moat, and on top of everything else, a pivotal role in the national security of some of the wealthiest and most important countries in this world. So I think that it is very well positioned. It has it has strength, therefore it can leverage its strength to have better margins, make customers pay more, and so on. So yeah, these are why I've picked these numbers for the assumptions that I've made. So here we see the calculation for the terminal value. You can use it. Yeah. Here you can see how I've done it. And yeah, here's the present value of that terminal value. And next, we sum up the value of the future cash flows and the terminal value. Then we subtract the debt, and we take out the expenses that are not yet realized but could possibly dilute our equity, such as options to the management and restricted stock units and performance stock units. That's also a bonus for the management, for the employees, and so on. So yeah, you have to take that into account. I didn't use the Black-Scholes model for a simplistic reason, in order to ease up the process. Probably the value is slightly higher than this, but it's not something that can really change the overall valuation of the company. So yeah, so here's the estimated value given these figures over here, and it's not that high compared to the current share price. But we have to say that I think that in this valuation, the beta plays a pivotal role because it's mostly made of equity, the capital of Palantir, and usually this is just used as a reference, the past, the beta of the past. A lot of analysts tend to normalize the beta because in theory the beta in the long run should tend towards 1. So if we expect, for example, the beta for the coming years to be around 2, we can see how that changes, and it changes quite a lot. It goes down by a point, and if we say that it were to go down, for example, to 1.7 or 1.5, let's make 1.5, it would make it extremely cheaper. And as I said, I think that in good times, especially if rates would go down, Palantir would rely more on debt rather than equity, so it would make the cost of capital go down dramatically. And I think it could go down like let's say 7.5, and then we make 6.5. We can see how it changes the valuation. It would make it like 40% higher than the current share price. So it would change a lot. So these are the assumptions, and for example, we can make the assumption that it actually grows more than this. We can see that it has done extremely well from 2022 to 2023. It has almost tripled the free cash flow. If we say that, for example, in a short run, it grows by 60%, and in the medium term, it grows by 30, for example, we can see that the valuation almost is more than double the current share price. So I have stayed extremely conservative for before, but if we take, for example, these assumptions, it would make the value of Palantir extremely higher than this. Yeah, so these are my valuations. You have to account that in that case, probably the valuations of the options and the valuations of the restricted stock units and performance stock units would be a lot more. But yeah, the valuation for the existing equity investors would be still really good compared to the current share price. So Palantir, we have seen that in a pretty bad scenario, the fair price would be around the same price that it is today. But I think that going forward, Palantir will consolidate and therefore increase the margins, continue to increase the revenue, and on top of everything else, reduce its cost of capital. As I've said before, the guys from Convequity, I've done a video with them a few years ago. They've done Palantir at the time. They estimated the cost of capital to be around 11.5. But in this case, it would be a little bit lower. The Fed is expected to cut, but yeah, it's not that far from the previous expectations. So yeah, we can make it, for example, let's make it a little bit higher. Let's make it 8, and then let's make it like 7.5. In this case, the stock would be still almost valuable as twice as much as it is today, almost. So yeah, I think that Palantir, great company. It is still on a really good growth path. It can still improve its margins and improve the free cash flow, and going forward probably it will rely more on debt, and that would be good for the equity holders. So this is it for today. I'm Giacomo, this is Also Hub. Make sure to like, subscribe, and comment for the next stocks you want me to analyze, and I'll take them into consideration. So this is it for today. I wish you a great day and see you next time. Bye.